Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Here's what we're watching this hour. First up, we'll assess the health of the global economy as the OECD says AI and monetary policy have offset impacts of the trade war. Plus, we'll sit down with the CEO of Strategy to talk about the state of its business as Bitcoin comes under pressure. And the CEO of Signet joins us to discuss its latest results and the health of consumer spending as well. Let's take a look at the major averages here on the Wi-Fi Interactive. We've got the Dow recovering a bit from yesterday's losses, up just about 0.25%. The S&P 500 up a little better than a third. The Nasdaq leading gains up about 0.9%. We continue to watch what's going on in the bond market as well. As one of our guests pointed out earlier, a little bit ironic to see the expectations for a Fed cut coming up and yet yields a little bit higher, although call it not much change today. And of course, we continue to watch what's going on with Bitcoin. Here we see a little bit of a bounce back up towards 90,000, above 89,000 right now. Here's the 2-day chart. If you look at the 5-day chart, you see the slump that we have been seeing in Bitcoin. So we're continuing to track that. And then, as I mentioned, the Nasdaq is the best performing of the three major averages today, leading gains. NVIDIA, as we speak, is presenting at a UBS conference, reiterating its confidence in the AI trade and that AI, it says, is not a bubble. That's something we heard from Jensen Huang when the company came out with earnings, but still those shares are up right now by about 3%. And we see some strength, albeit modest, in the other sort of Mag 7 names here today. If you look at sectors in the S&P 500 right now, you've got energy and consumer staples that are dragging, but tech is performing the best today, up about 1.6%. Well, the Organization for Economic Cooperation and Development, OECD, it says the world economy has shown surprising resilience to U.S. tariffs levied since President Trump took office in January, and the OECD projects 3.2% growth this year globally. The group also raised its U.S. growth forecast for 2025 to 2%, though that would still be a significant slowdown compared to last year. Joining me on set now is Michael Reed, RBC Capital Markets U.S. economist, who warns of fragmentation in the U.S. economy, and he expects prices to continue to rise next year and outpace wage growth. So, Mike, it's good to see you. Let's talk about the OECD first and this perception that growth. I want to get into the work that you guys have done on the wealth gap and spending gap, but I do want to talk about what's going on in terms of that global growth outlook from the OECD, and that the economy has weathered tariffs better than had been expected. So what do you think about their 2% forecast for the U.S.?
Sure, it's good to be here. And, in terms of the global growth outlook, we generally agree with that view in that we are expecting the U.S. growth outlook for 2026 to be slower than what we've seen here in 2025. And a lot of that has to do with what's going on with respect to the shifts in trade, as well as the uncertainty and really a lot of the inflationary pressures that are weighing on a lot of the consumers here in the U.S. So as we think about this, the best way that we've been able to explain what's going on is by quantifying this phenomenon that we've kind of been calling the K-shaped economy.
Right.
And it's a divergence in how people are feeling about economic prospects here in the U.S. And it's best exemplified by this divergence between consumer sentiment and the macro data. And the way we think about that is when you have folks who are, feeling uncertain about their economic prospects, if they're a little bit unsure about their job prospects, they vote in these consumer surveys, and they have an equal weight to all other people who are voting. Conversely, when you think about the macro data, and in particular the consumption data, you don't have an equal weight there. Your spending power is really weighted by your income.
Right.
So that's what we talk about, and what we mean by this divergence in that K-shape. You have a disproportionate spending that is being done by a very small group at the top of the income.
Well, let me ask you something too, because we frequently talk about the gap and divergence between those consumer surveys and spending surveys. But usually the interpretation is, well, these people say they're not confident, but they go out and spend money anyway. But what you're saying seems to imply we're not talking about the same people necessarily. The people who say they're confident are spending the money, but they're disproportionately counted in a way in the spending. Am I capturing that right?
Yeah, absolutely. That's a big part of the story. When you think about what's gone on since call it 2021, we had a lot of pandemic relief. A lot of folks benefited from that. At the same time, we had inflationary pressure, supply chain disruptions that came and caused a massive shift in price levels. And one of our studies early on identified inflation as being part of this force that is causing the divergence, in that inflation disproportionately impacts folks on the lower end of the income spectrum. Now, what's going on right now, though, is really a reflection of more so wealth. And what's driving that has been kind of the life cycle of what folks are investing in. And I think this is really interesting because it plays into a lot of our themes and what we're looking at in terms of 2026. But kind of the overarching theme is there's a big overlap. If you were to draw a Venn diagram of the high income households and baby boomers who are in retirement or about to retire, they have a lot of spending power right now, and it's a very large group.
I want us to show the chart, if we have it, of how much people are spending by income, right? By their income decile, which is a chart that was included in this report. And it's pretty telling. We put all the, to be fair, you had these as all individual lines on the bottom, the income deciles, and we put them all together. But obviously there is a huge gap, and this is something that's been cited a lot this year, is just that the top 10% of all earners are accounting for really the majority of the spending, which is pretty astonishing. From an economic perspective, when you look at aggregate GDP growth, it doesn't matter, so to speak. Or does it matter? Like how, in other words, we keep talking about this K-shaped economy. From an economic perspective, when does that come home to roost, and why does it matter?
Yeah, it definitely matters. And it matters based on what happens moving forward. So as an example, what we are expecting is a continued drift higher in the unemployment rate. So that means the folks who are in the kind of phase of their life where they're still working and more reliant on wage and salary income are going to feel pain if they do lose their jobs or if their wage growth slows. And we're already seeing that, especially for workers who are at the lower end of the income spectrum. Their wages have slowed notably following that post-COVID boom. And so they're not feeling so great about their job prospects right now. On the other hand, you have the group at the top, this top 10%, that has benefited from this wealth effect. We've seen a huge rise in the value of assets like housing, the stock market's done well, and increasingly we are seeing interest income that is benefiting this cohort. So in many ways, while you have the upper income households benefiting in this environment, and in fact they're benefiting from the Fed kind of keeping rates where they are right now, the lower end of the income cohort would benefit if the Fed continued to cut, because that would lower their interest rate burden that they are facing. So that's one dynamic that really matters. And I think the other dynamic that matters, again, is kind of the inflationary pressures. And the big question right now is, will the tariffs that were implemented in 2025 continue to put upward pressure on prices and increase the budgets necessary for a lot of folks to maintain their lifestyle in 2026? Well,
and conversely, for the rate cuts, maybe it will be helpful for people who are trying to buy a house, or there are other interest rate sensitive things. But on the flip side, what's the risk that it fans that inflation further?
So that's certainly one area that's a concern, right? You'll have an inflationary environment that will kind of handcuff the Fed. If you do see inflation start to reaccelerate, for example, it's going to be really hard for the Fed to justify further cuts from where we are. On the other hand, if you do see job losses continue to tick up and we do see a rise in the unemployment rate, we do think that opens the door for the Fed to start cutting. But at the end of the day, when you have a group like that top 10% that continues to spend the way they are, if you don't see a pullback in consumption, it means that we're going to see pretty sturdy GDP growth next year. Not to say it's going to be outstanding. We are looking for sub 2% growth here in the US, but largely that's just going to be driven by this very small cohort.
And just quickly, your colleague Lori Calvasina just came out with her forecast for next year, and she's looking for continued gains in the stock market. How does the sort of economic backdrop of sub 2% lend itself to that? I mean, I don't know how much you can speak to what she, her rationale.
Sure.
But, I'm just curious.
So we do talk a lot, and I think what's really interesting is Laura uses a lot of different models, and she lays out her views very well. In her year-ahead report, she is looking for the S&P to continue to rise here, but noted some key differences in that target based on economic growth. So as an example, she did say, if you do see something like a surprise closer to 3% GDP growth in 2026, that would be an upside for the S&P. Conversely, and to the tune of 10%, I think was her number. Conversely, when you think about some of the downside risks, if we see growth somewhere anywhere from flat to 1%, even a contraction in GDP growth, that presents a downside risk for the S&P, in her call, roughly around 10% decline. And that's the concern for us, is if you do have a drop in the stock market, you start to have folks feel that wealth effect dissipate. And it's not just the stock market and spending that we're concerned about. It's also some of the labor market dynamics that we've talked about. And so what that means is you could have a lot of folks look at their retirement portfolios who maybe are within a few months of retiring and say, maybe I'll hold off and wait another year or two. And that has ramifications for the labor market. A lot of what's happened over the past few years, the past 2 years in particular, has been this huge rise in retirements. That creates replacement demand. And that's an important concept because it ends up putting downward pressure on the unemployment rate without that kind of robust growth that you typically see with payrolls. So there's this disconnect now. But in our view, that's okay, so long as retirements continue at this record pace.
Right, which is supported by a rising stock market.
Exactly.
Really interesting point there, Mike. Thank you so much for coming in. Appreciate it.
Thanks for having me.
Well, President Trump is expected to name a new Federal Reserve Chair to replace Jerome Powell. We've been doing a deep dive into each of the 5 candidates on the short list: Fed Governors Christopher Waller and Michelle Bowman, former Fed Governor Kevin Warsh, National Economic Council Director Kevin Hassett, and BlackRock Head of Fixed Income Rick Rieder. Our Federal Reserve correspondent Jennifer Schonberger is here with a closer look at Kevin Warsh and what his leadership would mean for the Federal Reserve. Hi, Jen.
Good morning, Julie. There was a period earlier this year when Kevin Warsh was viewed as the favorite to take over Fed Chair Jay Powell's job. While he's no longer seen as the front runner, many analysts do see him within the top 3. And Warsh has had plenty of experience navigating within the central bank. President George W. Bush nominated him to be a Fed governor, serving from 2006 until 2011. In fact, he became former Fed Chair Ben Bernanke's liaison to Wall Street during the 2008 financial crisis. Now, before serving at the Fed, Warsh was special assistant to President Bush for economic policy and an executive secretary at the National Economic Council, where he advised the president and senior administration officials on the U.S. economy. He's also worked in M&A at Morgan Stanley, and he holds a degree in public policy with a focus on economics and statistics from Stanford, as well as a law degree from Harvard. He is also a known figure to President Trump, who considered him to be Fed chair 8 years ago during his first term before ultimately settling on Jay Powell. Now, Warsh has been highly critical of the Federal Reserve, recently writing in an op-ed in the Wall Street Journal that the Fed should, quote, disregard its forecast of stagflation, arguing that it's overlooking that AI will be a significant force that will boost productivity and push down inflation. He has criticized Chair Powell for making, quote, unwise choices, such as missing the persistence of post-pandemic inflation. Warsh rejects the belief that inflation is caused when the economy grows too fast and workers get paid too much. Rather, he argues inflation is caused when the government spends too much money and prints too much money. Warsh also says he thinks that that he views tariffs as one-off increases in prices, a view echoed by both the White House and many members of the Federal Reserve. Warsh believes that the Fed's policies are actually holding the economy back right now, that the U.S. is in a housing recession. He believes that interest rates should be lower than where they currently are, and that the Fed's balance sheet should be smaller than where it is right now. Julie.
Thank you, Jennifer. Appreciate it. Coming up, Signet Jewelers reporting disappointing guidance despite a strong third quarter. We'll talk to the CEO about the state of the jewelry industry. That's next on Market Catalysts. Signet Jewelers reporting a weaker than expected forecast for the fourth quarter. Still, the parent company of Kay Jewelers and Zales topped third quarter expectations with same-store sales up 3% year over year. Joining me now, J.K. Szymanczyk, Signet Jewelers CEO, and our executive editor, Brian Sazzi, with me here on set as well. J.K., thank you so much for being here. Just give us sort of big picture, your views on the quarter and, this narrowing of the forecast, maybe the thinking that went into that.
Sure. Yeah. Thank you guys for having me. Excited to talk about the quarter. We really had a strong quarter with growth across all merchandise categories. And I think the thing that stands out the most about the quarter is the validation of our strategy, our Grow Brand Love strategy, and in particular, our focus on our core brands to drive growth. Kay, Zales, Jared leading the way at 6% comp to fuel a 3% same-store sales growth across our business. And of course, that we did a nice job of pulling that through and doubling operating income on the quarter. So really pleased with what our team has done in navigating what has continued to be a tricky environment all year and continuing to build improvement. As far as our guide's concerned, our guide for the fourth quarter has, from day one, been guarded. We recognize the consumer's facing a lot right now. We certainly see that in the November consumer confidence reports, and I don't have to repeat for you the headlines that they're facing. So we really have maintained that guide, pulled up the bottom, and continued to raise despite the strength we've seen in the business, in part because we still have that same uncertainty to navigate from a consumer standpoint. I think the one thing I'd point out that maybe people lose a little bit of sight of relative to the guide is the fact that we've really pulled any downside from tariffs off the table. Our team has done a great job of navigating some of the volatility there. And at one point last quarter, we would have called out the bottom half of guide, in particular if India tariffs stayed in play. And despite the fact that they're still there, we've been able not only to reaffirm, but pull up the bottom and feel good about the way we're going to be able to close the year and are positioning ourselves to navigate what we think is some uncertainty from a consumer standpoint, but retaining the flexibility to make sure that we can be there to deliver value for customers when they want it most for the holiday.
JK, you mentioned on the earnings call this morning, you've seen some softer traffic the past 5 weeks. Is that focused on one specific brand, and within categories, where are you seeing that consumer cautiousness?
Yeah, look, I thank you so much for the question. It's really not evenly spread at all. Those of our brands that are really more aligned to upper income, higher end have stayed stronger and maintained momentum. Those of our brands that set outside of the U.S. Absolutely have maintained the momentum we've seen within the business. November for us, while I know a lot of the world really turns to holiday in November, even though we've got 1 month under us, it's we've got over 70% of the quarter ahead of us. Our big month is December overall, and November, even Black Friday, Cyber Monday are less impactful on our quarter overall. What we did see in those brands that have a little bit more exposure to lower and middle income customers, we did see some pullback in traffic, at the start of November, and that maps to all the macro events that I know you guys have been covering, and certainly what's reflected in consumer confidence. But we've also seen we've seen improvement in conversions, which gives us really good confidence on our positioning leading into the quarter or into the holiday, and probably most importantly, we've got strong conviction around the work we've done to really position inventory at key price points to deliver value for the holiday, which was admittedly an opportunity for our business last year. We feel like that's an opportunity for us to drive some upside in the business and to be there as consumers navigate this holiday season.
Let's talk a little bit more about pricing, because just as we are very aware of the consumer sentiment surveys out there, we're also very aware of what's going on with the price of gold and silver on the one hand, and diamonds not going in the same direction on the other. So what does that mean for pricing for you guys? How much ability do you feel you have to pass on some of those increases to your consumers, especially, as you say, as you've been navigating the tariff uncertainty at the same time?
Yeah, hats off to our team and to our partners for a lot of great work. I mean, on the tariff front, we've done everything from navigate countries of origin, pulled some production to the U.S. We've leveraged some supply chain efficiencies to really not only mitigate any of the headwinds that might come from it, but also, maybe more importantly, to preserve the value proposition for our customers. We've got a big, broad set of brands in our portfolio that really cover the gambit of a lot of focus on the middle, and I think making sure that we safeguard that value is one of the most important things for us. As far as gold's concerned, we're in uncharted waters. What I would tell you is, historically and even to date, we've seen that customers understand the commodity value of gold, and as we pass through any commodity cost changes, while it may impact how we think about design, or may impact even some unit velocity, we find that customers understand that value proposition and are supportive, particularly as we think about how do we position ourselves relative to the competitive landscape to still leverage our scale and deliver value for them. Silver, to a lesser degree, I think we're seeing some renewed interest in silver, in part because of some of the higher cost of gold. And even as we go into this holiday, we've got brands like Zales that are leaning into key items. 1 carat sterling silver, lab-grown tennis bracelets, sub $500. We really see that as an opportunity to help drive stronger value propositions for customers and be there at key price points.
JK, help an older guy such as myself that is unmarried. Why do sub 30-year-olds love lab-grown diamonds today? Is it just a price thing? What am I missing? Yeah,
I think it's, I think the important, narrative to keep in mind around diamonds is that there really is a love for both, and there is an opportunity for growth in both lab-grown and natural. For us, it is more, I guess, noteworthy at lower price points. In particular, on the engagement side of things, Brian, when you talk about sub $2,000, this is an emotional purchase, and it's all about maximizing emotional value. And if you're budget constrained, then in particular, the cost benefit of lab grown in those lower price points is something that resonates more. Maybe more importantly for our business, the fashion opportunities around lab grown diamonds are really what we get a little more excited about. I'll stick with the example of the tennis bracelet that I just talked about. To be able to hit more approachable price points where that can become a part of my fashion proposition every day, particularly in a world that's driven off of stacking as a trend, that really does open up an item like a diamond tennis bracelet to a broader set of customers overall, and makes it more approachable. Lab also, because you're not dealing with yield loss and some of the scarcity that are involved with natural, which are unique, beautiful, and special, it really does give you some degrees of freedom around design. So, we see it as an opportunity for continued growth on both sides of the business, and generally within our portfolio, the more you move up in average unit retail or income demographic, the more that customer is going to lean towards and appreciate the beauty and allure of a natural diamond over all else. And the more you look at a budget-constrained customer or someone who's looking for everyday fashion, I think the more relevant lab-grown diamond fashion is, and the more that comes into play in our mix.
So Julie, when that day comes for me, I think I can afford like a 10-carat lab-grown diamond here for that special person.
Wait, did you say when that day comes?
It's not happening today. Tomorrow, but why not go big with a 10-carat lab-grown diamond for maybe 10 grand? I don't know.
I don't know what the price point is. We got to talk about that offline. I finally want to ask you mentioned competition, and I am curious how you guys think about competition, in particular from the sort of online upstarts. I learned about something today called Ring Concierge, which I hadn't heard about, but apparently is in high demand. I think of something like Majuri, right, which has, I'm sure taken some shares. So how do you, these sort of online native, influencer native, how are you thinking about competing with those brands?
Well, I think a couple of ways. I mean, one, the more that we work to delineate and differentiate our brands, the better off we are at being stronger as a company collectively, but also being able to compete a little bit more so individually, depending on the player. Point number one in our Grow Brand Love strategy is really not thinking about our business as banners, but thinking about our business as brands. And the more we build brand equity, the better we compete against whoever, whether they be upstart or well-established. I think the other real opportunity for us is the more we extend into everyday and really lean into fashion as a growth opportunity for our business, the more points of contact we have with the customer. And then I'd say the third kind of leg of our stool relative to our strategy at work is modernizing our marketing playbook. We've got an opportunity to continue to improve our digital experience, which I think is going to be important. We certainly have an opportunity to shift our marketing spend to not be as top of the funnel driven, but engage in conversation with customers across a variety of inputs. And we've shifted our spend pretty dramatically in that regard. I think that's one of the reasons why we're seeing, in particular with Gen Z, that's the fastest growing customer cohort that we have. And you said it, there's a lot of players out there, but the more we can engage in that conversation and really serve up our value proposition and the strength of our collective portfolio of brands, then the better off I think Signet will be, and that's driving growth for us year to date.
JK, thanks so much for joining, Brian, and I really appreciate it.
Yeah, thank you very much for having me. Have a great holiday, guys.
Thanks, you too. Coming up, we'll talk with the strategy CEO about what it would take for the company to sell Bitcoin and the establishment of its first US dollar cash reserve. We'll be right back. Strategy shares are back in the green along with Bitcoin today. Now, CEO Phong made headlines when he said on the podcast What Bitcoin Did that the company would consider possibly selling some of its cryptocurrency if needed to cover its dividend. But then the company announced it had acquired 650,000 Bitcoin now. That's the total, just over 3% of the total supply. It also established a $1.44 billion US dollar cash reserve that would cover that dividend for 21 months. Phong Le is joining me now, CEO of Strategy. Thank you so much for being here. It's great to have you. I was just listening to that podcast where you talked about the dynamics at play with the company, Phong. So really happy you're here. Now, as of the close yesterday, the so-called market net asset value, MNAV, which is a barometer a lot of folks talk about with your stock, it was at about 1.15. And you talked about the potential for considering a Bitcoin sale, as you said, from a mathematical perspective, if you got to a 1-to-1 MNAV. So you'd gotten pretty close there. I mean, what you're thinking about when that could be necessary, or does this cash reserve now make that unnecessary?
Yeah, look, we have a Bitcoin reserve for the purpose of the long term of the business. And now we've built a US dollar reserve for the purpose of the short term of the business. We don't want to be in a position to sell Bitcoin, but below 1x MNAV, it doesn't make sense for us to issue equity to pay off our dividends. We built up 1.44 billion. We will target 2+ years of cash reserves, if you will, US dollar reserves. So we don't have to sell Bitcoin. Let's say that gets us to 3 years. If there is literally a 3-year sustained Bitcoin down cycle, a 3-year sustained cycle where MNAV trades below 1x, then we may have to sell Bitcoin. At this point in time, it's the end of 2025. We're talking about 2029 where that may be the case. And we have the Bitcoin for a reason, to protect the company, to protect our shareholders. And if we have to sell, we will.
And the cash that you all put into this reserve, this $1.4 billion reserve, is the cash that you have raised from selling shares, correct?
That's correct. It's from selling equity at a premium to MNAV, which by definition is accretive to our shareholders.
And of course, you have now embarked on a more recent strategy where you have been issuing various types of preferred shares. and getting cash from that. There's sort of more credit-like instruments. We've talked to Executive Chairman Michael Saylor about that. What is sort of your capital raising plan for the rest of this year and going into 2026 when it comes to selling either the common equity or more types of this preferred equity?
Yeah, our preference is to increase our amplification by selling more preferred equity. We really just started this in January this year, and the idea of a perpetual preferred to buy Bitcoin is a pretty novel idea. Look, it's as novel as in 2020 when we said we were going to become the first Bitcoin treasury company. It took, I would say, about a year for people to understand what we were doing. Then we layered debt on top of that, and we became a Bitcoin treasury company that leveraged ourselves. And that took people a year, 18, 24 months to figure that out. And now we're issuing perpetual preferred, which we think is superior for a variety of reasons to traditional debt, to convertible debt. It's going to take 18, 24 months for the market to figure this out. But it's not just the market understanding what MSTR is doing. It's the market understanding that a perpetual preferred instrument that pays 10 and now three quarters a point, that's STRC, is better than other alternative things that you might be able to invest in. So it's going to take a while to season the market. Could be a year, 2 years, 3 years. At that point in time, I think we'll be able to really grow a lot of capital through our perpetual preferreds. The big challenge people had with them was how we're going to pay the dividends in the short term if we see volatility in Bitcoin, volatility in MSTR. Now we've created this US dollar reserve to address that challenge.
I'm also curious when it comes to your Bitcoin buying strategy. You guys have pretty consistently bought that Bitcoin, and it seemed pretty price agnostic. Is there any thought of going forward? I mean, listen, everybody says it's tough to time the market. I get it. But like, buying lower is better than buying higher as a general rule of thumb. So is there any sort of plan going forward to try to maybe not buy more on the higher side and more buy? I mean, I think that your average cost to purchase at this point is above where the price of Bitcoin is right now, if I'm not mistaken.
Yeah, I split buyers into sophisticated buyers into two categories. You have investors and you have traders. Traders are PhDs working at hedge funds who have, large desks with 4 screens in front of them, and they're making decisions at the millisecond level of when to buy and sell Bitcoin or buy and sell equities or derivatives, et cetera. That's not us. We're investors. And when you see an asset class like Bitcoin and you believe in it, you just buy it when you're able to raise capital to buy it. And that's our strategy, right? We are not Bitcoin traders, we're Bitcoin investors, and that's the distinction there. I'm pretty sure that if I tried to become a Bitcoin trader, I would lose to more sophisticated Bitcoin traders. So we just buy when we have excess capital or when we're able to raise capital.
So Phong, as we talked about, Bitcoin is going up today, right? It's been on this downswing recently. But when you do sort of scenario preparation, simulation, what have you, and you think about Bitcoin going to 80,000 or even going to 60,000 or even going to 40,000 or lower, what would these various levels mean for your ability to pay that dividend?
I think there's two things. There's Bitcoin price, and then there's this price of our equity, which drives MNAV, right? And we've seen this in previous scenarios where Bitcoin price goes down, has a massive drawdown, but our MNAV is still above 1. And so it's accretive to our shareholders to issue equity, to pay dividends, to buy Bitcoin. And so, in fact, let's say Bitcoin price, hypothetically, hope it doesn't, goes to 40K, and our MNAV is 2x. It's actually more accretive to buy Bitcoin, issue equity to buy Bitcoin, and MNAV of 2x when Bitcoin is 40K. So that's sort of probably the primary difference here. It's not just a function of Bitcoin price; it's a function of our equity price. And then, the big question becomes, well, what drives your MNAV? Right. And what drives our MNAV is the ability for us to be accretive in adding Bitcoin per share. Right. Do people believe that we can add Bitcoin per share? Can we raise more capital either through equity financing or debt financing or now preferred financing? And do they believe that the management team is doing things in a thoughtful, way and a transparent way. So that's what we really focus on. And so, yeah, I think when Bitcoin price goes down, we see that as a buying opportunity as long as we feel bullish about the enterprise overall.
Do you, are you concerned at all that as that MNAV has compressed, that, you know, despite the sort of management that you're talking about, that your stock will be less appealing, even if you do acquire more Bitcoin, because people can buy an ETF that's more of a one-to-one to Bitcoin. They can buy cryptocurrencies themselves. I mean, how much are you concerned about that, and what, if anything, can you do about it?
Yeah, we face this question. You know, some folks have been following strategy for the last year. Some have been following us for the last 5 years, some for 20 years. Those who have been following us for the last 5 years have seen this exact sort of movie play once before. We had a crypto winter in 2022. It went through 2023. At the beginning of 2024, we had spot Bitcoin ETFs launched. IBIT is probably the best known of the bunch. And the same exact question arose, which is what happens in a Bitcoin winter and what happens when your MNAV starts to compress and there are alternatives out there. And I think this is probably one of the maybe less understood notions about strategy, and we see it now coming through discussions of MSCI and the indexes. We're not an ETF. We're not a closed-ended fund. If you were, you could see the company trade to MNAV or even below MNAV. We're an operating company that creates our products as Bitcoin-backed securities, right? And so in that particular case, the valuation of the company shouldn't be equal to the underlying assets. The valuation of the company should be equal to the ability to grow the underlying assets, grow income, and grow the business. And so we look much more like a Mag 7 tech stock than a closed-ended fund or an ETF. And I'm not sure exactly why people don't quite understand that, except many people don't understand Bitcoin and many people don't understand financial markets. But we are an operating company that creates Bitcoin-backed securities, and we should trade at a valuation equal to our ability to grow Bitcoin per share and our ability to grow our operating income, just like any other operating company would be conceived and thought of.
Phong, I could go down that rabbit hole. We could be here for another hour. But I finally, what I want to ask you is this. You know, most people are used to seeing the face of this company as Michael Saylor. So I'm very happy to be able to talk to you today. But I'm also curious what you want people to know about you as somebody who has not been. I mean, you've done podcasts as we mentioned. But what would you want people to know about you as the CEO of Strategy?
Look, my background is not much different than Mike's. I'm an engineer. I'm a technologist. I like data. I like software. And that's how I came upon Bitcoin. I have an MBA, so I have, and I was CFO here, so I have a lot of financial background too. And I feel like Bitcoin, I sort of feel like I was made for Bitcoin. The intersection of technology and finance, capital markets, macroeconomics has been what I've been doing my entire career. And 2020, it just became this aha moment when Mike said, hey, what do you think about this? So I love strategy. I love Bitcoin. And I think the potential for both is tremendous. And I'm very excited about the future.
Well, and you guys also have in common that you both make sure you get the orange on when you come to talk to people like me. Phong, thank you so much for your time. I appreciate it.
Thank you. Thanks for the opportunity.
Coming up, much more market action. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma, live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of Symbotic, United Software, as well as Six Flags. First up, Symbotic. Shares falling this morning after Goldman Sachs downgraded the stock to sell from neutral. Year to date, the stock is up more than 200%. The analyst said he attributes the major run-up to market interest in automation as well as robots. Now, the company is known for its robotic warehouse automation, and it teamed up with Walmart earlier this year. But the analyst said other new independent customers have remained limited in recent years. Next up, Unity Software. Wedbush added the stock to its best idea list and upgraded its price target to $55, up from $50. The analyst said the company holds a strong position in the expanding game engine and mobile advertising markets, and that could support sustained revenue and profit growth over the coming years. And lastly, Six Flags. Truist upgraded the stock to buy from hold. The analyst said the new CEO, John Riley, who was a former SeaWorld executive, sounds promising. He also said there's no denying that Six Flags has issues that it needs to solve, but he believes the company seems to be acting with greater urgency and is working with those activist investors as opposed to against them. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Now time for some of today's trending tickers. We're watching Apple, MongoDB, and Credo Technology. First up, Apple. The company's head of AI is departing the company, and that departure comes as Apple has struggled to keep up with Silicon Valley and generative AI. In a statement, Apple said the AI chief will depart this upcoming spring. However, there will be no replacement for him. Instead, Apple's opting to break up the artificial intelligence team across several divisions. Next, MongoDB. Those shares up more than 25% after the database software company reported stronger than expected results. It also raised its full-year forecast. The company saw continued strength in Atlas, which is its cloud-based services that help companies automate tasks. Both Morgan Stanley and Barclays boosted their price targets on the stock. Morgan Stanley says the new CEO is confident in the opportunity to become a generational data platform for the AI era. And finally, Credo. Those shares are surging to a record intraday high after its second quarter earnings. The company reported revenue that beat the average analyst estimate. Its revenue forecast came in well above estimates. Wall Street has been quick to respond, with analysts across the board increasing their price targets on that stock. Coming up, the rise of prediction markets, why the surge in popularity could come with risks. That's next on Market Catalyst.
Well, prediction markets are seeing a massive surge to end the year, with platforms like Polymarket and Kalshi suddenly drawing big money and big players. But as more people pile in, so do the questions about financial risk. Joining me now is Mahir Bhatia, BofA Securities Payments Analyst. And Mahir, prediction markets used to be pretty niche. Now we have these big exchanges, we have big investors. Is this the start of a new asset class, or is it just, another form of gambling at the end of the day?
Good afternoon, Ali, and thank you for having me. So I think that's an interesting question. I think in a lot of cases, it is, while prediction markets and sports betting, I think it's hard to argue that is an asset class, right? At the end of the day, what consumers are doing is making a call, whether it's from a predictive standpoint or it's just sports wagering, making a call on where they think how a particular event is going to unfold. So I would classify it a little bit more in the camp of gambling and wagering. And from our perspective as a consumer finance analyst, one of the things we worry about is just credit risk and consumers getting overextended and how companies can deal with that situation. So from our standpoint, I think it's just a way for consumers to potentially overextend themselves and lose money.
Yeah, let's talk about some of those credit risks, what that poses for companies, for lenders, along with consumers. What are you most focused on here with the rise of predictive markets?
Yeah, so I think it's important to say a couple of things here, right? First is it's early days in these markets. So, research is still developing, but what we have seen from academic research and from other data points is that consumers do tend to see an impact on their credit scores, on instances of bankruptcies, credit delinquencies, when sports betting in particular becomes more widely available, particularly online or through mobile apps and mobile phones, as opposed to just being generally available. And so that's something that we're quite focused on. But again, I do want to keep it in context, right? The headline numbers tend to highlight how much was bet, but consumers don't obviously lose everything that was bet. Only a small percentage of that is actually the losses. But that said, for a lender, this is a new risk, right? If you think about underwriting models, they were built on historic data, typically, and that was in a world where consumers couldn't just pull out their mobile phone and make a bet or a wager and potentially lose some money that way. So from our standpoint, the risk really is that there could be some mispricing of risk. Lenders have built their underwriting models and have sent out credit cards or personal loans, assuming a certain type of risk appetite, and now you're having a new risk vector potentially introduced for the consumer.
So if that risk keeps growing, is this an area where regulation or guardrails can contain it? And is Congress or other government entities, are they even prepared to handle something like this at this point?
Yeah, no, I mean, absolutely, you could see some, Congress and you could get some guardrails from regulators. We don't have a particular, I personally don't have a view on where that is and whether Congress has the appetite or the desire to implement something like that at this time. I think what's more important, I think, for an issuer or a credit card lender or a personal loan lender is they're going to have to take the action themselves, right? They cannot wait for regulation and they cannot wait for someone else to do the job for them. They have to manage their credit books, so they have to monitor their portfolios quite closely and see how this develops in different jurisdictions as that risk becomes more prevalent. I think that's what you'll see lenders do, is that they'll have to manage their books a little bit more proactively and account for this new risk vector.
Now, it's interesting, Mahir, because your research shows that the biggest impact is concentrated among younger men, lower income consumers where liquidity is already tight. So why is that the case, and why are they most vulnerable here?
Yeah, I think it's, some of it is just from the fact of that these people generally have less income, particularly when you think of lower income folks, or subprime populations. They tend to be a little bit less historic, like they're subprime for a reason. They tend to be a little less responsible in managing their credit. And what you tend to see is that with some of these gaming apps, prediction, the interfaces, the way they're set up, their prediction markets are really set up around this idea of gamifying the entire experience, incentivizing folks to bet more. And those are the populations that tend to be more active in these apps. And therefore, I think that's where the risks are. And then you combine that fact with the fact that, someone who's lower income or someone who's historically been less responsible in managing their finances, hence they ended up in the subprime tier, is going to be a little bit more at risk because they just have less buffers in place, right? They just have less income, less savings to fall back on than maybe someone else. So it's a combination of both where the companies are targeting and just personal behavior.
So how do you think this feeds into the K-shaped economy narrative that we've been discussing for quite some time? Does this worsen that divide maybe?
Potentially, yes, right? Potentially, yes. But again, I do want to keep it in context that, it's still early days. It is, and you do want to think about the fact that not all the headline numbers of, the dollars wagered is not necessarily everything that's lost. But that said, yeah, I think it worsens it, right? I mean, if the people who are going to be losing money are more susceptible to some of the advertising, some of the incentives that are put in place tend to be some of the people at the lower end of that K, if you will. And if those folks are losing money, it does worsen the dynamics around the K-shaped economy.
Yeah, super interesting stuff. We'll see how the prediction markets play out. But Mahir, thank you so much. Appreciate it.
Thank you, Ali.
90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. Taking a look at the major averages here, we have stocks actually rising to their highs of the day. We got the Nasdaq leading gains of 0.9%. We've been seeing tech lead pretty consistently throughout the day. Nvidia shares are up around 3%. The S&P 500 up 0.5%, as is the Dow. December trading, though, did get off to a soft start with stocks breaking their 5-day winning streak Monday. They're ticking higher today, as we've been talking about, as some risk on sentiment returns to markets. According to my next guest, a potential Santa Claus rally to close out the year all comes down to the Federal Reserve. Jeff Hirsch is Stock Traders Almanac editor. He is back with me now. Jeff, good to see you. So we've been talking a lot here about seasonality of December, that it has tended to be a good month, although less of a good month in more recent years. So as we get underway here and you consider the backdrop, how are you thinking about December?
Well, December is one of the best months of the year, and we have to thank my illustrious late father, Yale Hirsch, for being the one that put all this in everyone's mind in the Almanac. But we also need to look at December, the inner workings of it. The beginning of the month tends to be weak. We have a chart that's up on our blog as well as the newsletter that shows the early part of the month tends to be driven by tax loss selling and tends to be some weakness coming out. And then mid-December, the market starts to take off, and that's where we get our Santa Claus rally, which I must remind everyone is really an indicator and not some tradable rally. It is the first of our January indicator trifecta, as Yale coined. If Santa Claus should fail to call, bears may come to Broad Wall. So we're watching that for clues. Now, another thing about seasonality is that when it doesn't show up, either bearish seasonality or bullish seasonality, it's an indication that there are other forces at play. So we're watching to see if this seasonally bullish period actually comes to fruition. And if it doesn't, it's a sign that there are other forces that are stronger and may really have their say when that seasonal period ends. So it's key to watch it, not just expect it.
And of course, one of the big, maybe other factors that's quite powerful is the Federal Reserve, whose meeting next week could give us some cues about what's going to happen before the end of the year. As you know, it's broadly priced in now and broadly expected the Fed's going to cut rates. How are you thinking about that, and what kind of risk that is?
Well, about 10 days ago, it was kind of the opposite until Governor Williams made a speech down in Chile telling everyone that, oh, you know what, maybe we should cut rates. You can see it on the chart. I have a line on one of the charts I have with Bitcoin and Dow, S&P and NASDAQ on the 29th of October when Powell waffled backwards from cutting. And the bottom was the day after, the day of the Williams comment. So it's all about the Fed. I mean, there's a lot of other noise out there. The AI bubble, the Bitcoin crumble, all that going on. But it's really about the Fed and rates. And I think, they need to do the right thing and probably cut, because that's what the market's telling it to do. Not just the stock market, but the bond market has been telling it that. And if they don't, the market's going to get upset like it did before.
Yeah, I mean, at this point, as you say, because Williams has kind of managed those expectations, it seems like that's the path the Fed is on potentially. I know that, among other things, you're watching small caps pretty closely, Jeff.
Yeah.
People have been waiting for them to come back all year. Part of that's been contingent on the Fed, and it hasn't quite materialized. So what's going to change there?
Well, we're seeing the seasonal stirrings of the small cap outperformance. There's something called the January effect, not to be confused with the January barometer, which is the tendency of small caps to outperform large caps in the month of January. Our research has shown in the Almanac that January effect, that small cap effect, tends to take more of its effect the last 2 weeks of December. And some of the other comparison charts that we do, again, posted on the blog and in our newsletter, shows that the small cap outperformance of Russell 2000 versus the 1000 is starting to pick up right in line with the seasonal behavior. Low interest rates definitely help. I think we've been waiting for more than a year for small caps to wake up. And we're seeing it stirring seasonally. We're seeing it, just across the board. So it's encouraging. But again, we watch these things. We expect a small cap effect. I'm looking for rally into the end of the year. Next year's a different story, but I think small caps are going to turn around here. We got to watch out for the midterm year next year and what the January indicator trifecta tells us.
And talk to me about sentiment sort of more broadly here, Jeff, investor sentiment, because I know that's something that you watch as well.
Yeah.
And, what does that tell us about where stocks could be going?
Well, I like the investors' intelligence reading because it takes a read on people that actually, get paid for what they do. It's not just a survey. Some of the put call stuff is a little bit hard to track these days with the zero date expiration options. But sentiment had gotten pretty frothy back in October with, the market making new highs in a couple of months, September and October, new all-time highs. But it's backed off a bit. And, sentiments, retail sentiment's a little bit sketchy. But I think the fact that we've seen sentiment come down and sell off sets us up for a little bit of a year-end rally. But as I said, I'm concerned about next year. I mean, the midterm year is the worst year of the 4-year cycle. We had the bear market in 22. We had the Christmas crumble in 2018. It sets up, especially if we can make more new all-time highs by the end of the year, early next year, for that weak spot of the 4-year cycle, Q2, Q3 of the midterm year in 26. Sets up a great buying opportunity, but I'm already concerned for next year not being anywhere near as strong as the past 3.
And what are the sort of fundamental factors that you would look to, or fundamental risks that you would look to increase that possibility that we could see that sell-off?
I mean, I think we're seeing it underlying in the risk-off trade with Bitcoin and the sort of rotation out of the AI stocks. I mean, I think we're at the early stages of the big boom. I remember I put out a book a bunch of years ago called The Super Boom, and AI tech is all about that move. But there's going to be a pause. I think also the policies of the tariff policies probably going to take a little bit of an impact next year as it starts to roll through the economy. And then the midterm elections itself tend to take attention away from the market and into the political arena as the current, incumbent administration battles to control Congress. And I think we've seen from this president, he's pretty keen on being involved in that. And I think that can impact the market, which it has over several decades, as we show with the 4-year cycle, in the Almanac.
Jeff, great to see you. Thanks for joining us.
Always a pleasure. Thanks, Julie.
Coming up next, we'll talk with the CEO of Mattermost about how AI is redefining cybersecurity in 2026. Stay tuned. You're watching Market Catalyst. Cybersecurity giant CrowdStrike is set to report third quarter earnings after the bell today. Our next guest is pay close attention when those results come out because they'll tell us whether companies are maintaining their security investments even in the face of IT budget tightening. I'm joined on set by Ian Tien, Mattermost CEO. Thanks so much for being here.
Yeah, thank you, Julie.
Just so people know, Mattermost, you guys are sort of provide a Slack-like service in addition to other services, correct?
Yeah, 100%. So we go on-premise with private clouds, private AI. You can do your workflow collaboration and have all your sort of agentic training and data completely private.
Okay, so you have that software background and cybersecurity background, just so people know where you're coming from when we talk about cybersecurity. So CrowdStrike's sort of maybe a bellwether in terms of this spending. What should we be looking to see whether that cadence is keeping up?
Yeah, so CrowdStrike is a bellwether of large security deals and the market in general. And what it's really about is, well, if CrowdStrike is accelerating, then the entire market has that opportunity. If it's wobbling a little bit and its projections are a little down, what does that mean for the folks that are maybe not at the same tier at CrowdStrike? So I think in that sense, it's very much a bellwether and something really to watch.
Interesting. Okay, what kind of changes have we seen in the cybersecurity landscape over the past few years? There's been this whole platformization trend among these companies where they're trying to say, come to me for all of your cybersecurity needs. How has that changed the landscape, made things safer, less safe? How do you think about that?
So absolutely, there's consolidation, and platforms like CrowdStrike are a big sort of broad brush of suite-based capabilities, and a lot of people are moving towards that. They're like, here's one vendor, sort of one throat to choke, one organization that can help consolidate all these different security spends. At the same time, there's risk of over-concentration, which is now what we see is not only in cyber, but also in cloud, you've got global infrastructure that has outages once in a while. We had AWS, we had Azure recently, we had Cloudflare recently. Last year, CrowdStrike had a pretty notable outage. Mm-hmm. So you've got this wonderful benefits of consolidation. Hey, it all sort of works together, but you've got a lot of systematic risk. So what a lot of vendors are thinking about right now is how do I mix my global infrastructure with sovereign investments, with my old school sort of on-prem systems just in case, or multiple global platforms.
I was just going to say the old school on-premise is quite interesting to me. I mean, do you think we'll see not a backlash against the cloud, but more of that redundancy trend of on-premise?
Yeah, that's a great question. So it's not going to go back to the old on-premise, right, which is very expensive and difficult. It's really going to be private cloud. And I think a couple folks to watch are Oracle and Google, which have made significant investments in their on-premise cloud offerings, their sovereign cloud, which you can run in a box in a data center and have a complete control. You have all the benefits of cloud and you have the ability to scale. And Microsoft and AWS have their offerings as well, but Google and Oracle are really leaning into those on-premise clouds, plus the AI capabilities on-premise.
Okay, so you mentioned AI, and obviously we've seen so much spending on the part of so many different companies that feel like it's almost a mandate. They have to spend on this stuff. Where does cybersecurity then fall when you have all of this money going in one direction?
So the great news is a lot of the early prototypes of these AI scenarios are really working. You see a tremendous efficiency. The challenge is now you have 500, 1,000 different vendors that are all doing AI, and you've got this challenge of AI exfiltration, which is taking data out of your company, training things for your competitors' benefit. And it's very difficult because what you have in the world is information security. I can secure my information. We have theory, we have tools around that. What we're not prepared to do is secure synthetic information. So what is gleaned from that information can flow out of the company. And that's different than any other system we have. So that is a big gap right now in the whole security tool space. How do I work with synthetic information? How do I prevent its exfiltration, the training based on my data? And I think that's going to have a tremendous upside in the security market when that technical problem is solved.
How close are we to solving that problem?
There's a lot of startups and there's a lot of innovation. So it's either build it yourself with one of the leading cyber players, and they're certainly investing, or there can be consolidation. You'll see potentially M&A that really provides this capability across the board.
Whenever we talk about cybersecurity, we talk about the tools that the good guys have, the bad guys unfortunately also have. So now that AI is something that everybody has, how much more of a threat does that mean that the so-called bad guys, pose relative to historically?
It's a massive threat, and what's happening is you have a nation-state cyber actors really innovating on weaponization of AI. So that's a lot of impersonation. That's your voice, your photos, right? Your video. Everyone's remote right now. So how do I create synthetic people? And we've already heard cases of this with sort of technology that's like a year behind. What does it look like when you've got this AI innovation? When you've got Nano Banana and all the different Gemini products right now that can create very, very convincing deep fakes, which means like who can you trust now online? So that weaponization, that nation-state actor threat is absolutely there, and that technology is absolutely being weaponized today.
Well, and it seems like also that regulation is going to have to play a role when it comes to deepfakes. The whole idea of watermarking, that there needs to be some sort of standard, but it doesn't seem like we're there yet in terms of that policy is not there yet.
The policy is always going to be lagging the technology, and the challenge is like the technology can move so much faster, and the nation-state actors won't be following the regulations. They'll be using their models that aren't coming from big tech. They can use the different sort of open source and customized pieces. So the regulation is, of course, going to be beneficial to reduce sort of the attack space, but the most advanced actors will still be weaponizing.
All right, the world's not getting any less scary. Ian, thank you so much for being here. Appreciate it.
Thank you.
Coming up next, we'll get you a breakdown of leveraged ETFs, plus a check on the markets after several announcements from Amazon Web Services that's sending those Amazon shares higher. We'll be right back.
Welcome back to Yahoo Finance. I'm Brooke Tamama, live at the NASDAQ here in Times Square. Let's get a quick check of the latest market action. We're about 2 hours into today's trading session. After Monday's was a bit of a down note to kick off the last month of the year, we are seeing some renewed optimism across all three major indices, with the NASDAQ leading the momentum, up about 0.4%, the Dow up about 0.3%, and the S&P 500 trying to hold on to those gains, up more than 0.1%. Now, keep in mind, December typically is a solid, strong month for the markets, up about 1.4%. And so we'll be waiting to see if we could see a similar return this last month of the year, after we are seeing a bit of a reversal to kick off yesterday. But Bitcoin is seeing some renewed optimism, perhaps that floating into the equity markets as well. Bitcoin up more than 7.6% this morning. Ethereum seeing a similar pop of up about 10%. And also other Bitcoins all in the green, other cryptocurrencies rather, all in the green this morning. But I do want to jump to the NASDAQ, because what we're seeing there is this renewed optimism and perhaps a pullback as this AI competition intensifies. Amazon got a bit of a pop after we're seeing some headlines from that reInvent conference coming out. Amazon did release a new AI chip. They said that this AI chip can see, or rather AI developers can see a cost savings of about 30 to 40% with these new Amazon chips. And so you see a bit of a pop there when that announcement was made around 11 a.m. and now paring back some of those gains, but still up about 0.5%. And on the flip side, you could see some other AI players pull back a bit. Broadcom down about 1% 2 hours into today's trading session. Also AMD, Micron falling as well. Intel holding onto some momentum, up about 6% in intraday trading, whereas Nvidia, really the leader of this AI revolution, is about up only 0.4% as we make our way into this trading session, and still down about 1% over the past 5 days. But taking a look at the crypto stocks at large, also moving higher today after they also saw a pullback yesterday during yesterday's trading session, as there was this risk-off sentiment that really went through the market. But once again, taking a step back, all three major indices in the green this morning as we make our way into today's trading session. And also there seems to be this renewed optimism around what the year end can bring, that Fed rate cut happening next week, and also this return to cryptocurrencies. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout the trading session.
What happens when you stack leverage on top of leverage in the crypto market? In a nutshell, well, that is the simple question that we're seeking to answer on today's Stocks in Translation, which has some slightly complicated answers. So as we dig into the shadowy world of leverage ETFs, buckle up, but we're going to guide you along step by step. So let's begin with a chart to illustrate how leverage can hurt on the way down. Here we have iShares Bitcoin, IBIT, as our Bitcoin proxy, and we also have Strategy. That's over the course of this entire year. Because of its huge Bitcoin reserve, which it funds with sales of stocks and other securities, Strategy has become a high-octane bet on Bitcoin. And if you look closely, you can see that Bitcoin peaked in October, but Strategy peaked long before that in July, and it's down 65% from there. And while our Bitcoin ETF is down about 5% year to date, Strategy is off closer to 40%. Now let's add one more layer of octane. We're going to take MSTR versus its 2x cousin, and this is Defiance Daily Target 2x Long ETF, ticker MSTX, and there are others. I'll break down leverage ETFs in a minute, but all you need to notice here is that if MSTR looks bad, its leverage version looks absolutely brutal in downturns. Leverage bets on Strategy are down over 80% this year alone, with $1.5 billion in assets evaporating recently. So what exactly are people buying here? Leverage ETFs are exchange-traded funds built to track 2 times or 3 times the daily moves of a stock or an index using swaps or options. The key word here is daily. These funds are reset every single day. They're not promising 2 or 3 times the return of a stock over 6 months or a year. They're aiming for 2 or 3 times whatever happens between today's close and tomorrow's close. And that's where the trouble starts for many. Let's run through some of the pros first, because there are legit uses for these funds. Leverage ETFs can amplify short-term views. If you think a stock is going to pop over the next few days, you can use less cash to make that bet. And they can be very useful to experienced traders who understand the toolkit and they watch their positions closely. But on the flip side, these funds track daily, not long-term returns. That means that the path matters as much as the destination. Big up and down swings, they can erode gains over time, even if the stock eventually gets back to where it started. They're not designed as buy and hold investments. So if you hold them through a lot of volatility, the math, it can work against you very quickly. So where does that leave us? Here's what to keep an eye on. First, pay attention to Bitcoin price and volatility. These products live and die on big daily moves. If crypto volatility stays elevated, the math inside leverage funds stays a bit rough. Second, for MSTR, the pros watch what's called the premium or the discount to its Bitcoin stash. You don't necessarily need to understand it if you can read a chart of MSTR and Bitcoin itself. Just ask yourself, is MSTR leading or is it lagging Bitcoin, and in which direction? Study the charts of what's happened historically. Third, you can watch Bitcoin and related ETF flows. If money starts rushing back into plain vanilla Bitcoin products, that could take off some of the pressure from these leverage sideshows. If flows keep chasing leverage instead, the risk is going to remain elevated. Fourth is kind of big picture, but you might want to keep an eye out on new single stock leverage ETF launches. This is where the systemic risk question lurks. Right now, these funds are still a small slice of the overall market, so they probably aren't an immediate threat to market integrity, as it's called. But as more single stock products launch on thinner, more volatile names, their footprint in the plumbing of the market, it grows. And that's something that investors and regulators are going to want to keep an eye on long term. Bottom line, leverage ETFs are powerful tools inside the right hands for short periods. They can do a specific job. In the wrong hands, over too much time, they can turn a plain vanilla loss into a life-changing wipeout. And tune in to Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts up next.
Wall Street's institutional adoption of crypto is progressing. Bank of America says its wealth management clients should now start thinking about getting some crypto exposure in their portfolios. The firm is now endorsing a 1% to 4% allocation to digital assets for clients. Joining us for more now is our senior reporter, David Hollerith. David, talk to us about why this is such a shift.
Yeah, Bank of America's decision to allow all of its wealth customers to potentially invest in Bitcoin ETFs is certainly not groundbreaking in terms of what other institutions have done. But if you look at this from the perspective of wealth advisors, Bank of America is a full-service wealth advisory, and it's also a bank. So in terms of regulations, it has kind of the most. Morgan Stanley is another big institution in that same camp that has done that. And so they have to give out a recommendation. I say recommendation, they would call it something like allocation parameters, but they have to do this before they can sort of instruct their wealth advisor team, which for Bank of America is something over 15,000 wealth advisors to go out and potentially pitch these to investors. And now the thing there is that very wealthy customers had already had access if they asked for it, but now effectively anybody with a wealth account with Bank of America, including everyday investors and also retirement accounts, can access these ETFs as of January 5th.
Interesting. And we've got Vanguard also reversing and saying they're going to allow trading of crypto related assets on their platform.
Right. I mean, that's probably even a kind of a bigger philosophical shift given Vanguard's perspective on Bitcoin that we've seen. And that also came out yesterday. And, to me, I think it's kind of speaking to this moment we're in. It's sort of ignoring the price movements for a second. But for the last year, given the Trump administration's reversal on sort of their crypto policy compared to the Biden administration, just how much mainstream institutions are sort of moving into crypto in various ways.
It is quite a moment, and you're here to cover it for us. Thanks so much, Dave. Appreciate it. Well, let's stick with crypto in your portfolio and how retail investors should be approaching digital assets right now. Joining us is Rick Edelman. He's author of The Truth About Crypto. And Rick, by the way, you're also out with a new book about college, but we're going to talk about that in a moment. I want to talk about crypto first here. 1% to 4%. We just talked about how Bank of America is now that those are their allocation parameters. Right. How does that sound to you in terms of how people should think about Bitcoin in their portfolio or crypto in their portfolio?
This is the standard allocation recommendation from Wall Street these days, which is, as we just heard, land breaking. I mean, this is huge. The fact that major Wall Street firms are now saying everybody should own at least some Bitcoin, typically single digits, low single digits. My attitude is put a zero on both of those numbers.
Really?
You should have at least 10%, not 1, up to 40% of the portfolio, not just 4. And it's because this represents the single best investment opportunity for the next decade. We know how wonderful it's been the past 16 years. This trend is going to continue as we see greater and greater adoption. Just look at Bank of America with its 15,000 financial advisors. Look at Vanguard with its 50 million customer accounts. If suddenly all of these trillions of dollars of portfolio holdings begin to allocate 2%, we're talking about tens of billions of dollars of flows going into Bitcoin, which is a fixed supply. This has to translate to major price increases.
Okay, over time, if that's the case though, and this is a trend that already has begun, why do we still see such volatility? Shouldn't that have dampened the volatility? Why do we still see this huge drawdown?
It has dampened the volatility, exactly right. If what is going on the last 6 weeks occurred 3 years ago, Bitcoin would be down 80%. It's not. It's only, I'll put that in quotes, only down 30. Because while there's massive deleveraging, a lot of selling, a lot of the Bitcoin whales from a decade ago liquidating to create liquidity for themselves now that they're multi-billionaires, while all the selling is going on, there is simultaneously massive institutional buying, which is helping to provide the floor, which is why Bitcoin hasn't dropped 80%. It's only been 30.
Rick, this gets to sort of a fundamental, sort of philosophical shift to me in the way that people invest in anything, which is that typically if you're investing for retirement, you want something that is going to provide a modest cushion for you. I feel like now there has been this shift into investing both in stocks and in crypto to make you rich. Is that the right way, though, to look at this situation? Isn't that highly risky if you're depending on it to make you rich?
I agree with the premise, but I'd use a different phrase. Okay. Instead of saying make me rich, I would put it in the context of make sure my money lasts as long as I do. And it's because people are recognizing longevity. We're seeing the likelihood that if you're alive today, odds are pretty good you're going to live to 90, 100, 105. You're not going to be dead at 85 the way our parents, grandparents, great-grandparents were. And that means my money's going to have to last as long as I do. And if I leave the money in bank accounts, T-bills, money markets, CDs, bonds, I'm not going to get the after-tax, after-inflation rate of returns that I need to keep my money growing so that it can generate the income I need. So do I need to get rich? Rich enough so I never run out of money.
I mean, maybe the competition isn't money market funds. Maybe it's just a regular old vanilla index fund that you reinvest your dividends in.
Absolutely right. And therefore, we need to recognize the mantra is, always has been, and always will be, diversification. So we recognize that crypto is simply another sleeve in the crypto asset class.
Yeah, 40% is a pretty big sleeve.
For an aggressive investor, for sure, and most are never going to go near that.
Yeah.
But my point is, a 1 or 2% allocation, if you're really trying to have a diversified approach and a rebalancing, modern portfolio theory approach, 1 or 2% is not going to cut it. You need 5 or 10. And that's what we're beginning to see advisors recommending. It isn't the 1 to 4, it's more like 5 to 10.
Are there any risks that you're concerned about?
Always, which is why it's only 5 or 10% of the portfolio. The biggest risk to me is investor behavior, is that they were totally excited, a little too enthusiastic when Bitcoin was 125,000. And they're a little too pessimistic when Bitcoin is 85,000. It's investor psychology, which is always the biggest challenge to overcome.
Number go up when it comes to crypto. One final quick question when it comes to crypto here. What's the best way for most people to invest in it?
The crypto ETFs, the Bitcoin, Ethereum, now Solana ETFs, more are coming online. The ETFs are familiar, we know them well, they're transparent, they're very inexpensive, highly tax efficient, totally liquid. It's the single easiest, best way for most mere mortals to allocate, and most of us are mere mortals when it comes to investing. So just do the Bitcoin and Solana and Ethereum ETFs, call it a day.
All right, speaking of mere mortals, like myself, with a kid about to go to college in a couple of years, we got to talk about your new book. It's called The Truth About College and is a guide for parents who want to help their teens answer difficult questions about higher education, not just where to go, which is, I think is most of the literature is kind of geared towards that, but just how to think about like what you want to do with your life and how college feeds into that. Is that a fair way to describe it?
It is. The question is fundamentally, should the kid go to college? I mean, there's no question college remains the best path. But that's only if the child is ready for college and they choose the path and follow it correctly. That's how they emerge with a degree in a field that is marketable. They can earn a good income. They can have a wonderful life. We know that college graduates make the most money in America. They're also healthier. They live longer. They are less likely to divorce. They have stronger family and community relationships. Going to college, getting a degree is wonderful. But how then do you explain that 24% of freshmen drop out, that only 62% graduate in 6 years, that the average person emerges college with $41,000 of student loan debt, that we have 37 million college dropouts in this country, that these days 25% of college grads say they wish they never went? Clearly, something's wrong in how we're executing this plan. That's what my book is about. Like you said, most books are all about choosing a college, choosing a major, how do I get accepted? No, ask the fundamental question, is my kid college candidate?
So, and I feel like also a lot of the recent questions centered around what you're talking about are kind of focused on return on investment and focused more on what can the college provide to me, which you don't have as much control over. You have more control over what your kid does and the conversations you have. So like, how do you have these, how do you figure this out?
So in my book, The Truth About College, there are, in the back of the book, 20 conversation starters for parents to have with their teens, asking these fundamental questions to help you decide together, is college the right path? Recognizing there are so many alternative paths today for free education, for apprenticeships, for vocational school, for taking just a gap year or two. Let the kid grow up a little bit more and mature and develop, see what the world a little bit more to help them determine, is college the right path? Is it now? What kind of school? What kind of major? So that the outcome is much more likely to be successful as opposed to ruining their lives.
I mean, it's pretty tricky though when you're talking about a kid who is 16, 17, 18, Even waiting another 1 year? I mean, in other words,
25% of college kids are over the age of 25. So not just waiting 1 year, maybe wait 5. Go learn about yourself, go travel, go get a job, see what it's like to have one, and see what the economic realities of the world are. That could help you frame your decision making.
Yeah, I guess I just think about myself and not figuring out entirely who I was until much later, which I think is true of a lot of people.
And this is a big mistake parents make, in fact, is that they thinking about their own college experience 20, 30, 40 years ago, or grandparents 60 years ago. College today is not like it was when we went to school, and we need to recognize the fundamental differences, the challenges kids are facing. By the way, we haven't even mentioned AI.
I know, I was going to ask you about AI.
And the incredible threats to most careers due to technological innovation. Many kids are studying majors for fields that literally won't exist by the time they graduate.
And I don't know if waiting a year is going to help with that. I mean, those feel like questions that we won't necessarily have answered for a little while.
And so I'll tell you the path that I describe in the book. There are 4 major things that you need to make sure your kid learns. And any college can teach these: thinking, creating, managing, and communicating. That is what you need to teach your children how to do, because that is adaptable in virtually any career. As opposed to, I'm going to become an engineer, learn how to code. Well, great. We don't need coders due to AI. So we need to learn how to think and create and communicate. You're in the communication field. This is transportable to cross industry. And this is what we need to help people realize, is that college of the past is not what exists today. The cost is so much higher. The challenge is so much greater. We need to rethink and reevaluate the approach we're taking. And that's what I help people understand in The Truth About College.
All right. Thanks, Rick. Thanks for coming in. Appreciate it.
My pleasure.
All right, coming up next, we are going to talk about the restaurant industry with legendary chef Mario Carbone. That is next on Market Catalyst. Carbone has grown into a household name as the high-end restaurant is pushed into the consumer goods space, selling the sauces it became famous for across the country. Major Food Group also owns more than just Carbone. It operates restaurants across all ends of the financial spectrum around the world, and most recently opened Carbone Riviera at the Bellagio Resort in Las Vegas. Here with me now, Mario Carbone, Major Food Group co-founder and managing partner, and chef, of course. Thanks so much for being here.
Good morning.
So I want to talk to you about what I am going to dub the Carbone indicator.
Okay, great.
Which is, as we said, you have a lot of different restaurants around the world. You sell these sauces. We are always trying to get a read on consumer spending. So what can you tell me about what you're seeing across your restaurants?
We're seeing that sort of at the high end of the spectrum, the sort of luxury sector of our portfolio, that we're really not seeing much change. If anything, we're seeing growth. I think that those customers we're continuing to be able to hold on to, I think cater to. Whether it's in New York, Miami, Las Vegas, London, we're trying to take AAA spaces in these major cities of the world. And by and large, we're seeing, if anything, stability, if not growth.
And what about at the sort of more casual end of the spectrum within your portfolio?
Yeah, I think that's where it gets a little trickier, and you're seeing sort of great deal of competition, if not triage, in that sector across the country. So for us, as we see growth going forward, certainly with this past year, with 2026, we're really focusing on AAA locations in the luxury sector.
And are you seeing, the spending in those higher end restaurants, are you seeing any kind of change in terms of beverage choices, for example, that people are making in terms of their willingness to spend? Is that holding up or even also going up?
It's definitely holding up. It's holding up. And then when we're coming into a new market where we haven't been before, like Las Vegas, like London or in Dubai, there's a great amount of enthusiasm. So we're getting a big opening push of people where we haven't been in that part of the world before. So there's a lot of enthusiasm, a lot of excitement. So spend is doing really well for us.
As I mentioned, you all have at-home products also.
Yep.
You have the sauces, and you're introducing more. You've expanded your line of sauces, some simmer sauces as well. So that also gives you a window into the at-home cook. So what are you seeing in terms of demand for those?
Demand for our CPG is through the roof. It's been an amazing journey. We're 4 years old now. We'll do $100 million in revenue this year of sauce alone. Wow. We're in 30,000 stores across the country, and we're starting to look internationally as well. So sort of everywhere where we open a restaurant, allowing that to be sort of the entree, pun intended, for selling CPG there as well. So that's been an incredible product for us and an amazing journey so far.
And that isn't, it's not the lowest price point, but it's not the highest price point, the sauces. And so is that telling you also something about, do you think that is attributable to the strength of the brand and or the idea that people are cooking a lot at home?
I think it's a combination of things. I think, yes, there's a strength of the brand and recognition of the brand now, nationwide, but I also think customers want quality. They care about their ingredients, especially when they're cooking at home, and they're willing to spend an extra $1 or $2 on that jarred sauce, and I think that our brand represents that. So I think people are willing to go to $9 or $10 for a jar of sauce because they know what they're going to buy is of the highest quality.
What about your costs at the restaurants, right? We talk all the time here at Yahoo Finance about inflation. There's a lot of talk about the affordability crisis. I know that your raw ingredients probably have gone up too. Have you been raising prices at the restaurants because you're seeing that happen?
Yeah, I think, listen, we monitor it really closely. We bring in ingredients from all over the world every day. For us, we sort of took a stance that we're not going to change our ingredients. We're not going to, tweak the recipes because of these tariffs. Like we're going to continue to provide the same product that we always have. If that means we have to pass it along to the customer, especially again at that luxury sector, I think there's a willingness to keep paying for it. What I believe is they'd rather pay for the exact same dish than us start to search for an inferior product because of the tariffs. So there's an unwillingness to change, especially being a chef in the core ingredients. We've spent so many years finding these ingredients, narrowing them down, working with farmers and vendors and fishermen that we're not going to change now. We're going to keep our products and we're going to just sort of pass along the expense.
I'm curious your thoughts in particular on this new proposed tariff on some of the pasta makers in Italy that could be as much as 100% that got a lot of attention recently. Are you bringing in dry pasta from Italy at all? And I mean, what do you think about that potential tariff?
We definitely bring in dry pasta from Italy. I think there's great pasta makers in the United States now that are going to get a chance to shine. We're going to probably continue to use the same ingredients that we've always used. But I think it's a great opportunity for those, local vendors who are going to be making them here in the States. But I don't know how long that's going to last. I think it's a really important ingredient on the supermarket aisle, especially in the Northeast.
Yeah.
So again, I think we're going to continue to buy those ingredients that we know because again, I need to know that spaghetti is 7 minutes exactly the same way every time. Like it'll cause chaos if I start changing these ingredients across 60 restaurants.
Right.
So we're gonna hold steady to those those ingredients, but I think it's a great opportunity for the American-made pasta companies, which there are a lot of.
Yeah, I mean that makes sense. On the flip side, do you worry about the economic viability of some of those Italian pasta makers who, maybe they don't all have the luxury of having a major food group as a client? That some of them might be forced out of business.
Yeah, many of them are small vendors too. They're still virtually family-run operations. Some of them that we use that I know for sure are not the juggernaut brands that they're going to be hit the hardest. So yeah, definitely a concern there. Hopefully it doesn't last too long because they are a dying breed to begin with. These craftsmen, these companies, it's a very special process.
Yeah. Here in New York, at least, I can only speak for New York, which I live in this area. It's really hard to get a reservation at your restaurant. Any tips? Any inside sort of info you can give us about?
I would come early. Look to take any availability that they might have, any last minute cancellations. But also we have a lot of restaurants, so I would try. I would try. Not just Carbone, but some of the other restaurants in the company. I would urge you to try as well. But as far as tips for Carbone, I would say come early, look for cancellation, and
sit at the bar.
Sit at the bar.
That's always mine. Go by myself and sit at the bar. It's always a good way to get into a place. Finally, I'm curious. So you opened this new restaurant, the Bellagio, but you also recently cooked in a temporary restaurant that was erected above the fountain at the Bellagio, right? That was put up for the F1 race. I was reading about it. The tickets were about $7,700, but you have every famous chef in the book cooking at this place. And it sounded like it was a lot of fun to do. Tell me about what that was like.
It's kind of the greatest buffet in the world. It's part high school reunion for all the chefs. So because we all know each other really well, so we look forward to that weekend every year where we get together. And it is pretty incredible to see us all lined up together. Chef Morimoto made a 60-foot long maki roll, and we all sort of jumped in. So to have all these chefs together making these things, it's a lot of fun. I think that carries over to the customer as well. You're right on the track. It's a pretty incredible experience. One of one, I'd say.
It sounded like it. All right. Thanks so much for
Thank
coming
you for having
in.
me.
Great to meet you. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.